Hi everyone, you asked for it and here it is, the deep dive comparison between SCHD and FDVV that could change how you think about dividend investing forever. Last week, one of you commented asking for this exact comparison. After diving deep into the numbers, I discovered something shocking that most investors completely miss about these two funds. One prioritizes rock-solid dividends and the other chases growth with dividends as a bonus. But which strategy actually builds more wealth over time? I'm going to show you the real data, the hidden differences most people never talk about, and exactly which fund fits your investment goals. This isn't just about picking stocks, it's about understanding two completely different philosophies for building wealth. The tale of two strategies, income versus growth. SCHD and FDVV represent two totally different approaches to dividend investing. SCHD says, give me companies that pay me today and grow those payments every year. FDVV says, give me companies that might pay less now but could explode in value later. SCHD launched in October 2011 with 14 years of proven data. FDVV launched in September 2016, so it's the newer kid with about 9 years of a track record. But here's what's fascinating. Despite being newer, FDVV has actually outperformed SCHD in recent years. The numbers that matter, performance breakdown. Let's talk about real performance with the latest data. Year to date, FDVV is absolutely crushing it with over 14% returns, while SCHD is sitting at around 2.5 to 4%. That's more than a 10% difference in the same market conditions. Over the past 3 years, FDVV's average annual return hit 21.3% compared to SCHD's more modest performance around 10%. But here's the catch. SCHD has historically been the more consistent performer over longer periods. When markets crash, SCHD tends to hold up better. When markets boom, especially tech-driven bull markets like we're seeing now, FDVV takes the lead. The yield game, current income battle. Right now, SCHD offers a 3.82% dividend yield, while FDVV sits at around 3.11%. If you're retired and need income today, that extra 0.71% from SCHD might matter a lot. On a $100,000 investment, that's an extra $710 per year in your pocket. But here's where it gets interesting. SCHD has delivered incredible dividend growth over the past decade. We're talking about an 11.59% annual growth rate in dividends. FDVV's dividend growth has been much slower at 2.87% annually. This means SCHD's dividends are growing much faster than inflation. The secret sauce? What's actually inside these funds? This is where things get really interesting. FDVV has massive exposure to technology, about 25% of the fund. Its top three holdings are Nvidia at 6.32%, Microsoft at 5.57%, and Apple at 5.09%. These aren't traditional dividend companies, but they've been absolute performance monsters in 2025. SCHD takes the opposite approach. It focuses on defense sectors like consumer staples, healthcare, and financials. Companies like Coca-Cola, Pfizer, and Amgen, businesses that have been paying dividends for decades and will probably keep doing it. The cost factor. Fees that eats your returns. Here's a huge difference most people ignore. SCHD charges just 0.06% in annual fees. That's only $6 for every $10,000 you invest. FDVV charges 0.16%, which is still low, but nearly 3 times higher than SCHD. Over 20 years, this difference compounds significantly and could cost you thousands. Risk and volatility. The sleep at night factor. FDVV's tech exposure means it can swing harder during market crashes. FDVV's maximum drawdown since inception was 40.25%, while SCHD hit 33.37%. That's a meaningful difference when you need to sleep at night. During the 2022 market crash, this played out exactly as expected. SCHD's defensive holdings helped it outperform FDVV when growth stocks got hammered. The selection process, methodology differences that matter. Here's where these funds are completely different under the hood. SCHD uses Schwab's famous 4-factor screening system. First, cash flow to total debt ratio. Can the company actually afford its dividends? Second, return on equity. How efficiently does the company use shareholder money? And third, dividend yield. Meaningful income without dangerous yield traps. Lastly, fourth, 5-year dividend growth rate. prove the company grows dividends consistently. This creates about 100 dividend champions that pass all 4 tests. FDVV uses Fidelity's completely different approach. The Fidelity High Dividend Index focuses on high dividend yields, stable cash flows, and strong financial health, but it doesn't require the same strict dividend growth history. Instead, it emphasizes market cap, liquidity, and sector diversification to stay balanced. The result, SCHD gets boring, reliable dividend growers. FDVV gets higher-yielding companies that might include more cyclical businesses and growth stocks that happen to pay dividends. Bull markets versus bear markets, when each fund shines. Here's the pattern that emerged over the years. In bull markets, especially tech-driven ones like 2023 to 2024, FDVV wins big. Its exposure to Nvidia, Apple, and Microsoft pays off massively when these stocks are flying. In bear markets or defensive periods, SCHD's boring companies like utilities and consumer staples hold up better. When people are scared, they want Coca-Cola and Johnson & Johnson, not the latest tech darling. Tax efficiency, the hidden wealth builder. Both funds are pretty tax efficient, but there's a subtle difference. SCHD's focus on established dividend growers tends to produce more qualified dividends, which get favorable tax treatment. FDVV's tech holdings sometimes prefer share buybacks over dividends, which can be more tax efficient in taxable accounts. The 10-year wealth building projection. Let's run some numbers. If you invested $100,000 in each fund 5 years ago and added $1,000 monthly, here's roughly where you'd be today. FDVV would likely be ahead in total value thanks to its tech exposure during the recent bull run, but SCHD would be generating significantly more annual dividend income. Looking forward, if tech continues to dominate, FDVV keeps the advantage. If we enter a more defensive market cycle, SCHD should catch up quickly. Portfolio integration, where each fund fits best. For young investors in accumulation phase, FDVV's growth potential might be more attractive. The lower current yield doesn't matter as much when you're reinvesting everything anyway. For investors nearing or in retirement, SCHD's higher yield and more predictable dividend growth might be exactly what you need for reliable income. The verdict? Which fund wins? Here's my honest take. After analyzing all this data, there's no clear winner. It depends entirely on what you're trying to accomplish. Choose FDVV if you want exposure to dividend-paying growth companies, can handle more volatility, and believe tech will continue outperforming. It's perfect for investors who want some dividend income but also want growth potential. Choose SCHD if you prioritize consistent dividend growth, want defensive characteristics during market crashes, and prefer the lower fees. It's ideal for income-focused investors who want reliability over maximum growth. Here's my personal 2025 strategy. Honestly, I own both. I use SCHD as my core dividend holding for stability and growing income. I use FDVV as my growth-oriented dividend play when I want exposure to tech companies that also pay dividends. The combination gives me the best of both worlds. SCHD's defensive characteristics and dividend growth, plus FDVV's upside potential during bull markets. Both SCHD and FDVV are excellent funds that serve different purposes. SCHD is the reliable income generator that grows steadily over time. FDVV is the growth-oriented play that happens to pay dividends. Your choice depends on your age, your risk tolerance, and what you're trying to accomplish. But remember, you don't have to pick just one. Many successful investors use both funds to balance growth and income in their portfolios. The most important thing? Start investing in whichever one fits your strategy and stick with it. Time in the market beats timing the market. Whether you choose the steady Eddie approach of SCHD or the growth-focused strategy of FDVV, remember to keep investing profitably. This content is for educational purposes only and is not financial advice. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Please like, share, and subscribe. Here's to your investing success. Profitable investing.